Good.
Right?
Yeah.
Oh, there it goes.
I think we're going.
All right. Live action.
Is this thing on? There's our intro this week. Hey, Tim and Tim don't know what they're doing.
Two knuckleheads trying to figure it out.
There's some people out there that might say, I knew that. Tim and I were talking about something before this that I'm sure there's some haters out there. But anyway, folks, hey, what's going on? Welcome to Tim and Tim at 10 on Tuesdays. Can't believe I got that out without stumbling over myself.
Alliteration, baby.
Yeah, I'm just not the most well-spoken individual in the world. But hey, guys, good morning. Hope you guys are doing well. Hey, Vitaly, what's going on, man?
I'm good, man. Just shaking things up a little bit. I put this on you to do the intro this week.
I know. It's completely not in my comfort zone. So I told you know what's interesting is I told people, I think it was last week, we were talking about something. Oh, they were talking about Jennings and Yeadon event in March.
Oh yeah,
and they were like, "What are you guys doing?" I'm like, "I don't know. Vitaly handles all of that." And they were like, "So you're going to be talking?" I was like, "I think so."
Yep. I could pull it together on stage pretty quick. He puts pretty good bullet points on. That's all I need.
Yeah, but they were like, "Oh, so this isn't your thing." I was like, "Man, if I'm talking at an event, somebody else probably asked me to do it, and or Volin told me I'm going to do it." Right?
Told, yeah, that's a good way. Yeah.
I was like, that's typically how it works. If you see the two of us on stage, Vitaly probably put it together.
Yeah, that's for sure.
Yeah. So,
all right, what are we talking about this week, Tim? Guys, I'm jumping at the bit here.
Oh, here you go. There's your high. So, folks, what we are talking about, we're going to talk about lending for a second. And I appreciate it, Dennis. Thanks for the positive feedback loop there. But yeah, guys, we're going to talk about lending because Vitaly was up early this morning apparently and sent me an email about how lending is picking up. Whoa! And as we were looking through it, I was like, "Hey, this is good." And then there was something at the bottom too. I noticed that I'm like, "Oh, maybe it's some good, some bad." But let's talk about lending and the fact that the transaction volume for lenders is picking up quite a bit. Yeah. What did you get out of that article?
I thought it was interesting. It was talking about CBRE's what do they call it? They called it their multifamily lending index or something like that. And it was up. Their lending transactional volume was up like 20 to 30% higher than last year's similar quarter. So Q4 2023 versus Q4 2024. Q4 2024 was up massively, like 30% or something like that, right?
Yep.
And at face value, I read that and I was like, okay, is the market turning around? Are things like are people getting more active here? Like what's really going on here? And that was a good call out by your response on the email this morning. It was like, this is actually a good thing, but it can also be a bad thing. And I think my takeaway from that whole thing was that the reason that the lending transactional volume is up is because banks are no longer doing is what they say is pretend and extend.
Right.
That's been the coined term of just giving out extensions so that they don't have to face the music. And hopefully the market's going to turn around so that they can refinance out. I think what we're seeing is transactional volume is up because loans are expiring and people either need to sell at a discount or for whatever their basis is to get out of the deal, or they are refinancing into a local bank. It actually said that the agency lenders, the lending with agency lenders, so Fannie Freddie, is down. And I personally think that the way that this article was worded, it said that the Q4 closings were up. It didn't say if it was acquisition closings. It didn't say if it was sales closings or refinance closings. It just said closing. So it's pretty broad, but I'd like to think that it was for refinances and sales. That the bank transactions are up because people are just, the banks want to get their money back, right?
Yeah.
They've lended it out at 2020, 2021, 2022 interest rates. And the 10-year treasury is at like 4.5 right now, which is, still pretty high comparative to where it's been, for years before that. It's back to like peak 2022, 2023 range, right? So the lending environment, in my personal opinion, has not gotten any better. I think people have just become more accustomed to where it's stabilized at.
Yeah, yeah, I would agree with you, man. Because on the, like you said, on the face value, like reading the article, like the headline and then the meat of the article, I was like, oh, this is good. This is good news, right? Now I will say, folks, like this is good news. You know, as someone who was doing some of the stuff in '08 and '09 when lending just completely froze up,
Mhm.
you know,
Yeah.
regardless of what the market's doing right now, the fact that lenders are lending. And it
Yeah, you've
sounds
been
like
saying that for years now.
yeah, I mean, because they weren't. Let's just remember that. But the good news here is, lenders are lending. In fact, lenders look like they're looking and projecting, hey, when am I going to get some capital back to re-lend? So it's not like lenders are looking to get their money back and then hoard it, because that's what was happening back then. They were getting cash back and they're like, I ain't doing nothing with it.
You know, banks don't want that liability on their books. Right? You
Right.
know, they got to turn that liability into an asset ASAP.
Yeah. So this time it looks like they're looking to project what they're going to get back. They're going out and they're forcing some of this to come back. They're like, nope, no more pretend and extend. Like you said, your extensions are up. We're not giving you another one.
Mhm.
And they want their money back because they want to redeploy it. So there's some good and bad going on there. I think to me, the bad news is if you got a loan that's coming due, it's probably coming due.
Yeah,
Um,
right.
your
Yeah, yeah.
your gra-
And
your grace period's probably over.
yeah, yeah, they're way less lenient.
Yeah,
Now, if you have extensions and things like that built into your loan, like, great, you're fine, right? I mean,
yeah,
you just contractually, you have the right to extend.
that's right.
Now, the bank doesn't have I don't know. The bank might not have to honor it because they do still go through, like, an internal I don't wanna say internal audit, but, they do assess it. They reassess the risk, and they, determine whether they're gonna grant you the extension that they granted
Right.
you, right? So it's not carte blanche, like, you don't just flip a switch, like, they still look at your financials. We've done some extensions and, we always meet the lender on site. We have a good relationship with a lot of the lenders now too, which is good, but they come do site inspections. They look at your financials a little more closely. They sometimes they want to hop on a phone call with you and ask, like, okay, well, the numbers say one thing, but what's the story of what's
Right.
going on here?
Yeah.
And they can tell if you're BSing or not.
Yeah.
So let's be clear there. But I do think that I wish that article had specified a little bit more about what types of closings were happening. Recently saw some posts on Facebook about foreclosures and people losing uh, a lot of money. So some of those people are very unhappy because their properties are getting foreclosed on. That counts as a closing, I think, right? Would
Yeah.
you count that as a closing on the bank side?
If they're foreclosing and selling,
Well, they're foreclosing on whoever purchased it, right? And
mm,
so they're getting the asset, right? But maybe they are now selling it for a discounted basis of whatever their loan balance is.
yeah, I mean when they sell it for a discounted basis, yeah, that's a closing. When they just take it back, that's not. But yeah,
Right. Yeah,
um,
no, I agree with you, Dennis. Banks are not in the property management game, so they will just try to get what they need and get out. Something I do want to bring up based on this statement is some of the pushback that we get in our coaching group and in the My First Million group and things like that. When I'm underwriting your deal and I'm pressuring you, saying, "Well, you're underwriting to, I don't know, like a 30% expense ratio, right?" Uh, I'm not saying that it's impossible, but I'm saying what you need to do in order to have an understanding of what type of debt and debt coverage you're going to have is
yeah,
underwrite it like a bank would, right? And that's
right,
also going to determine your value because it's going to determine what the bank values it at. The bank is not in the property management game, so they're going to be ultra conservative, and you need to include that level of conservatism. One pain point, that I look at all the time is people might underwrite to like a 3% repair and maintenance and claim, oh, it's a new property. There's not a whole lot going on. And it's like, it doesn't really matter. The bank is going to underwrite it to a standard of $750 per unit per year. So you need to underwrite it at the same basis so that you can understand how much cash you're going to have to bring to the table and what your lending and debt coverage is going to look like. Now, during the course of your ownership, if you don't spend $750 per unit per year, that's just additional cash flow to you and your
yeah,
investors. But to normalize the underwriting process to determine its true value and what the bank values it at, you have to underwrite it like a bank would.
yeah. A really good point, man. Because Tim and I have gone through a couple of things recently, just our not only in our class, but us looking to buy something or as well,
Hmm.
or maybe buy a partner out or something like that. And every single time it's been this isn't how the bank's going to look at this. Like
Hmm.
we can have this conversation, but this isn't how they're gonna underwrite it. So
Correct.
for us to have this conversation and look at like doing something, we're gonna have to look at like what we can go to the bank and realistically assume, right?
Right.
Um,
Correct. Yeah. Because yeah, they're going to underwrite it to whatever worst case scenario is. Maybe not worst case, but like what is a likely probability of what it will operate for them under their management if they had to take it over, and what will the market pay for it? And they're going
yeah,
to underwrite it with what you would consider industry standards or industry norms. On variable costs like that, right? Like some things
yeah,
are not variable. Utility costs, insurance, property taxes, those are not variable costs, right? So you're going to underwrite to what the actual numbers are there. But when it comes to variable costs like repair and maintenance spend, turn cost, sometimes payroll can be included in there depending on how efficient or not efficient you are. Uh, Advertising, like all of those types of things, right? So a lot of those things are not variable costs, so they'll be underwritten to a standard, like a market standard, rather than an actual number. Because one example is like if you're operating it and you're not spending your R&M budget, but maybe you're just doing everything yourself or it's really
right,
cheap, right? But that's not to say that the next guy is not going to be able to come in and do the same thing. It might cost them more money. So like you really didn't help yourself in terms of value by operating it lean. You helped
right.
yourself in terms of cash flow
Cash
during your
flow.
ownership, right?
Yeah,
So it's an interesting kind of give and take. It's the sword cuts both ways.
yeah, yeah. And man, that's one of the hardest things to make an owner understand is like I'm not going to operate it like you, right?
Right.
And the bank is not going to underwrite to the one-off scenario that you've created, right?
Right. Correct.
Maybe you can find a local lender that's like knows a guy really, really well and is like, yeah, I'll lend to you based on
Well,
what
so
you do. But
peeling on that a little bit is
yeah,
a lot of the reason those local and regional banks are able to get away with that is because they're lending to the guarantor on a
right,
global cash flow.
right,
Meaning they're looking at your other portfolio and essentially saying, okay, well, if this property doesn't operate that well, he can supplement cash flow from other properties to make sure that this one's okay. So they'll decrease your debt coverage ratio, they'll increase your leverage, they'll do a lot of different things for you. But it's not to say that it's because it's deal specific. It's because it's
yeah,
probably a full recourse loan, and they're looking at your global cash flow. And let's be honest here. If it's a full recourse loan and they're looking at your global cash flow, if anything goes wrong with that very specific deal, they can come after your entire portfolio and your entire net worth in order to make themselves whole to cover that deal. So
yeah.
is that more or less risky? In my opinion,
Uh,
way more risky.
You know what? It is funny, guys. It's almost like we planned this. I promise we didn't, because I wanted to dig into one little thing that article said, right?
Hmm.
And it's around risk tolerance, because the
Hmm.
article mentioned that the transaction volume of new loans and lending was an indication that lenders' risk tolerance
Hmm.
has relaxed, basically, like
Yeah.
they're more risk tolerant. I'm like, I don't think they are.
I don't think so
Um,
either, but I think it's
no,
because it depends on the carve out whether it's recourse or not. So, like this article was specifically vague, and it's hard to have specific conversation and facts because it
well,
is vague.
right, but like you said, recourse versus non-recourse. Recourse, you may get a higher, you may get a better DSCR, you may get a more better proceeds, right? Because they're offsetting their risk another way. Versus
Correct.
non-recourse, where they're like, hey, I'm only going to give you 60% because you can just turn in the keys and then all I have is a property, right?
Right.
Like, so I really don't see the risk tolerance changing. Me personally, I think what we're seeing is I think lenders' patience is running out. And
Ooh, that's good. Yeah.
I
Yeah.
yeah, I don't see risk tolerance changing because quite frankly, I haven't seen in any of our refis and any of our quotes, I haven't seen the terms of the debt changing. They've been
Mhm.
pretty consistent with the LTV, with the markets and all in the rates and all of this stuff. All the things that tend to indicate a lender's risk tolerance have been pretty static for the last 18 to 24 months.
Mhm.
Um, so I don't think the tolerance is changing. I think what's happening is lenders are just saying, "Hey guys, it's time. Like we've seen, we were holding because we thought these things were going to happen in the market. Well, I think we know what the market's going to do now. I think we know interest rates really aren't changing. They are what they are for a little bit. So, all of us hoping they were going to drop, a full percentage or something like that ain't happening. So it's time. It's time. It's time to just get this loan off our books and redeploy the capital.
Yep. Yeah. Their patience is running thin, but I think there's all the other side of it is like the industry as a whole makes money when people transact, right?
Right.
Title
Yeah.
companies, insurance companies,
Right.
banks, brokers, everybody makes money during transactions, right? So they're incentivized, they're running out of patience and they're incentivized to do transactions because they need to make money again.
Yeah.
Right. So I think that's why you've seen a big uptick in volume, right? Transactional volume,
Yeah.
because the patience is running out. They're putting their feet to their fire. They're saying, hey, like, shit, get off the pot, right? We gotta do something here because we're losing money by just holding this loan or this note for you because we can redeploy it into a new deal at a higher basis. We can make transactional fees and things like that. And all of our subsidiaries, the corporate entity or enterprises, I should say, sorry, we're going to make up the difference in our transactions, right? By doing stuff and keeping our feet moving rather than sitting and watching the paint dry.
Yeah, man. Like, think about that. If you're if you're a bridge lender that put something out in 22, right? I mean, what was your bridge rate? Like 7?
6, 7.
Yeah, 6, 7, 6.5, 7
I think the lowest bridge loan that I can remember off the top of my head right now was 5.75.
on a bridge.
Yeah,
Yeah,
on Rosewood, it was 5.75.
so you're
on a
sitting
bridge.
up there. You're sitting up there at 5.75, 6, 6.5, maybe 7%. You could redeploy that. You can get your 1.5, percentage origination fee at the close, and then you can sit there and earn 10, 11, 12% right now on a bridge.
Yeah. Yep.
Yeah.
Doubling your interest rate and then you also grabbing the points, like, makes sense, right? So they're like, yeah, you know what, we got to do something here. And it's the sponsors that have to do cash in refis or just go into foreclosure that are struggling.
Yeah.
I don't
So
think it's any like I know everybody's been talking about this and everyone's been waiting and waiting and waiting for these sweetheart deals. There's deals out there and they're not being publicly advertised. And I can tell you that the relationships that Tim and I built over the last couple of years are the reasons why we're getting access to those deals from brokers and from lenders directly,
yeah,
right? And it's not like hey, I'm going to sit here and I'm going to wait for Crexy for a bank to post a deal on the market. That's not going to happen. So sitting on your hands and waiting for something to happen is not going to happen. You have to get out there. You got to pave the pound the pavement, as they say, and underwrite some deals and build relationships with people. You got to be transacting in the space because the people that are transacting the most and that built good relationships with people in the area, those are the ones that are getting access to those types of deals.
yeah. And folks, like, for the last year or so, we keep hearing like, where are these deals, where are the deals, where are the deals, where they're coming, like they're coming now. Because you think about something that closed in 22 that a bank, somebody got behind and they had to turn it in or whatever. Well, look, guys, it takes a little while for a bank to work through that process, for a lender to work through that process. So now they're 3-4 years in, they're going to start to hit. Like I can give you an example just near me. I actually found this out a few days ago. I finally was like, what's up with this place? Right. I keep telling Tim about this place near me that's never opened up. And so I went and did the research on it. It's been sitting with the bank for about 12 months now.
Whoa.
Yeah. And it is finally getting ready to come out. But same thing, those take a while. So you're starting, you're going to start to see that. And then you're going to start to see the guys who are pressed, whose bank has given them time. And you're going to start to see them, like Tim said, it's like sell or, shit or get off the pot, right? Like you got to do something. You're either going to need to take the loss and move on, or you're going to have to sell at some sort of like crazy basis and move on.
Yeah. Now, the other side of the coin is like, you don't have to sell for a loss. If you can refinance and just trade out your debt and buy yourself time, that's the better option here. But there are people that underwrote to ridiculously low interest rates and didn't increase their property taxes, and insurance costs were $300 a unit and they should have been $900 a unit. Like, there's some deals out there that people just overpaid for, and there's not going to be anything except for a reset coming for them. There's no amount of I don't want to say no amount of cash in refi, because you could have an amount of cash in refi, but the bank is ultimately, they're only going to lend you so much, and
Yeah.
it comes down to your tolerance of how much money do you want to put into this deal and hold it so that you don't realize a loss.
Yeah.
So I don't know. It's interesting to see. I mean, there's a lot moving around, and the saying was survive to 25, and now it's not. It's there's a lot happening coming down the pipe in 25 because of the things that have happened in 23 and 24.
Yeah. Kick to 26. Is that where we are now?
Kick it to 26. Yeah.
Yeah. Yeah. But, hey, and one other thing, and Tim, I'll throw a softball at you. I think it's a softball. Like, why do you think, these are refis as opposed to new purchases, new sales, on these,
Because they're
numbers?
not going to be able to sell it to pay back their first lien, as well as all of the investor equity that they raised in order to leverage up to buy the property.
Yeah. So, and then the other thing too is, like Tim mentioned, we're highly connected to a bunch of different brokers, a bunch of different owners, stuff like that. I'm not hearing a whole lot of transaction, new sales, new deals happening, right? So all my broker buddies are telling me, hey, I did like the lowest volume I've ever done
Mm-hmm.
in 24, right? I don't see that picking up in 25, that kind of thing. Yet lending volume is significantly up. That, I mean, the pie, the writing's in the sky, right? It's like these are refis, right?
Yeah. Right.
Yeah. So
Yeah, it's interesting to see how it's going to play out. I mean, God, I wish I had a crystal ball and I knew exactly what was going to happen, so I can, you know, but you just got to go along for the ride and keep your feet moving. Ultimately, is the number one thing that you have to take away from this, is continuing to keep your feet moving, looking at options, looking at refinances, looking at sales, looking at acquisitions. A lot of people are kind of like in the wait and see mode on acquisitions, and I think if banks lending is starting to pick up and transactional volume is starting to pick up, I think this is what we're going to get for the foreseeable future. But Tim and I's model and motto has always been underwrite to what you have today, what you have access
yeah,
to today, and if the numbers work, you buy it,
yeah,
right? You build in levels of conservatism that anybody would in assumptions in your buying process. But if you can get a deal that works with today's debt and today's interest rates and insurance costs and all of the above, then you buy it, right? And then hopefully you have enough time to get through to be able to realize gains, because maybe the market starts to turn into your favor. But it's when it's like stock market, it's like people love to buy it when it's already gone up like this, because they're like, oh, it's proven itself, right? It's proven that it's going to go up. Now I feel comfortable buying it, when really the best time to buy it is when it's declining, right? And then you wait for it to kind of bottom out and then come back up again. And now you're like, wow, I got it at this great cost basis because I bought it as if everybody else was afraid and nobody really knew what was going to happen. It's like, yeah, I bought it when everything was red and it was difficult. But now that the market's turned, hopefully we're having this conversation in 2 or 3 years that the market has turned and buying activity is up, right? Well, Tim got all these assets now that we bought when it was difficult, and hopefully it will be very, very, very easy to sell them for a large profit.
Or think about this too. Like we always talk about, like, these mom and pops that have had something forever, why do they just hold on to it? Because it pays, right? It pays monthly. Like, just think about this. You're going into this period where you can get something with a cost basis down here, right?
Mm-hmm.
Cost basis down here. You sit on it for a little while. I mean, this is a really good time to pick up a legacy property.
Yeah.
Pick up a legacy property, sit on it for a little while, and then get that one that's just going to pay all your bills every month, and then go flip out of everything else if you want to. But
Yeah.
this is a good time coming up, I think.
Dennis, what are you talking about with the Section 8 shuffle? What do you mean by that?
You guys do the Section 8 shuffle.
Like the truffle shuffle?
I know what I do with it. I look at Section 8 sometimes and I go, what the hell? Like,
Yeah. Yeah, I'm curious to see what his response is going to be here, but yeah, Ben. It's interesting to see the articles as they come out from people that know a whole lot more than we do. We just continue to digest this information and try to apply it to our own scenarios. But yeah, I mean, now's a really great time to be in a position where you didn't buy something. Oh, keeping it moving, keep your feet moving. Yeah. One thing I like about Section 8 rents is they seem to always go up. You know, so one thing that I like is not being pressured to sell. A lot of the stuff that we bought, I would say, what, Tim, 90% of the stuff that we bought last year, it's got long-term debt on it.
Oh
We
yeah.
assume the loans, but they're not due for another 10, 20 years. I don't have to sell it. And our cost basis is great. And our debt service is very low. Those properties are not pressure. And it's, okay, let me relate that for you in another way. There is a property that just Tim and I own. We own it 50-50.
I was getting ready to mention the same thing. Go for it.
And there was only one vacancy on the property. And then I saw an email from our management company come through that we got a new application on it. And the rent for it was there's a handful of market rate units at this property compared to it being LIHTC, right? And it was a market rate. So we could go after full market rate, which was like $1,400 a month. But she filled it at $955 per month. And you said, you know what? I don't even care. It's full. It's paying, she's collecting 100% of the money. Our debt service is very, very, very low. I was like, you know what? It's better just to fill the place than to push the rents. There are other properties that we have that have bridge loans that are expiring, and we're watching those lease renewals and those applications come through like hawks because we need to make sure that we're getting the rent numbers to meet our pro forma to refinance. So the stress levels are entirely different when you have a stabilized product with long-term fixed rate debt that's covering its debt service versus an expiring bridge loan where you have to refinance and you have to get to your target, which ultimately, I'm not going to lie here, that's how Tim and I make money, right? That's what we do for other people is we syndicate those deals. We raise money. We do the forced value add. We underwrite the deals and try to hit on those pro forma numbers. So it's a representation of Tim and Tim's business if we do or do not hit those pro forma numbers. So the stress levels are entirely different. So what we're talking about now is a really good time to buy something that you can just let it be full, like not have to worry about pushing the renewals and pushing the lease numbers and pushing this and pushing that. And that's how you find yourself in a position with assets that you end up owning for years and years that you don't really, it's low stress, right? Because it's kind of on autopilot. It's just kind of, it pays itself. It's done. You send out lease renewals. What happens, right? So it's a much more laissez-faire attitude towards one of those properties versus one that has a deadline and a time cutoff.
Yeah, and that same one he's talking about, guys, like we're gonna do a little bit of a cash out refi at some point this year. But keep me honest, Tim. But I think our recent analysis on that was even after we pull some cash out, we're still going to be sitting at like a 2 DSCR.
Yeah, 2. That's what the lending broker said. It was like
2.
Yeah, 2 debt coverage ratio after pulling out money.
Yeah, after pulling out money and redeploying it elsewhere, this thing is still going to be paying for itself twice over every month. I mean, that's a good property to sit on for a little bit.
It's a great spot to be because you don't have to push people. And let me tell you, the number one way to have turnover in your property is to increase the rents. If you just renew people, they stay. They're not going to go anywhere, right? Yeah. So I can tell you, if we're at a 2 debt coverage ratio, and it's full and it's paying and I can pay myself every month from it or every quarter or whatever, I'm probably not pushing the lease, probably not bumping the rent to $150 a month, but I'm still going to go up $50 a month because I doubt people are going to move as aggressively over a $50 rent increase. But if you increase somebody's rent $150, $250, like, yeah, you're probably going to have to deal with some vacancy.
Oh, so in 100 versus 50, 150 versus 50. So you made an extra 100 a month. So you make $1,200 over the course of that year, but you spent $2,400 to turn it.
Correct. Yeah. That's so that right there. That's the key point. Most people forget about is, yeah, you would have made an extra $1,200 that year, but you lost a month rent in vacancy. You spent $24,000, $25,000, maybe even $3,000 turn in the unit. And then you're going to try to do it again all over next year. And then you keep digging yourself a hole. The best way to increase your profitability and cash flow is to keep it full and do regular, steady increases. But if you got a business plan to meet and a pro forma and expiring debt, like, you don't really have a choice. But all of that's built into your numbers, right? Because that's the expectation of the deal itself.
Yeah. Yeah. So.
Yeah.
All right.
Cool.
Well, guys. Man, Tim, anything else, man?
I'm good. Are you taking us out? Bring us in and take us out today.
All right, peace. No,
Oh, yeah. Peace.
yeah, we joke about that, guys. So anyway, hey guys, have a great week. Joe, Dennis, thanks for your comments, man. Always appreciate the feedback during the show. And hey, let us know what you need, and we're here for you. So have a great week, folks.
Awesome. See you later.